a company can grow without ever making a profit if it simply invests all of its cash flow into capital expenditure that then depreciates, and it does that forever. That business is worth nothing. It could be the biggest business in the world.
Hi and welcome. Today on Basis Point, we focus on the long game of active equity management. We sat down with Ben Peters, co-founder of Evenlode Investment, to talk about cycles, style headwinds, and what it really takes to stay disciplined when markets reward pretty much everything else. When quality investing falls out of favor, the hardest part isn't the analysis, it's resisting the call of the sirens, momentum, hype, and short-term comfort. If you enjoy our content, don't forget to like and subscribe. Just a couple of clicks that make it all worthwhile for us. This episode is about patience as a strategy and why staying put can sometimes be the most difficult and most rational decision an investor can make. Enjoy. So Ben Peters, in fund management, a lot of people talk about quality and growth in kind of interchangeable manners. There is a difference. Can you tell us a bit more about that? How you recognize that difference?
Well, absolutely. And if you put in the value piece, you've got the three kind of legs of the stool that define any investment, whichever your style. So I think that growth is helpful. It's much easier to be a quality business if you're in a growing industry. So declining businesses is difficult. You tend to have declining returns on capital. And actually, if you look, if you do market studies, companies with declining return on capital tend to underperform pretty materially. But there is a difference, a subtle but important difference between quality and growth, because a company can grow without ever making a profit if it simply invests all of its cash flow into capital expenditure that then depreciates, and it does that forever. That business is worth nothing. It could be the biggest business in the world. Most businesses do reach a scale where they create some profitability, but that's just a hypothetical. So, and then you have a sort of degrees in between, very, very asset-light businesses where competition is probably quite fierce because who wouldn't want those economics? And then there's probably a sweet spot and this is where we come in, where you have companies that are growing. Doesn't have to be really high growth, but they are able to reinvest in themselves at a very high rate of return. And they're classically called compounding businesses. And they are usually growing businesses, but aren't often high growth businesses. That's a different thing. So it's a subtle but important difference, because what we want to capture is the economics of that compounding inside the company. And to my mind, that is why there's often an opportunity in quality businesses, because that work goes on under the surface. It's really easy to look at revenue growth. I think NVIDIA is a great, current poster child for this. Growing really fast, very exciting, new technology, and there's nothing wrong with that, by the way. It's a great business, but that's something you can get excited about. Whereas a business that's growing its revenues at, say, 5 or 6%, doesn't sound that exciting. But if it's generating a 30 or 40% return on the invested capital within it, that's a very nice high rate of return inside, and it generates lots of cash flow, some of which can come back to us as shareholders. And it's that quiet kind of work of quality which I think really leads to the opportunity.
But steady and stable.
Steady, stable often, yeah, but that doesn't mean sort of no growth as well. They will, as long as they maintain their market positions and develop their products or service, whatever industry, they will grow.
And what are the biggest or the single biggest red flag you look at when you see that a good company is about to not be that great anymore?
Yeah, that's the challenge really in terms of quality investing, I would say.
How do you recognize shifting winds?
Well, I think there's a few things we look at. Declining returns on capital are one. Now, you can have a business that's got sort of very, very high returns on capital and they go to being high returns on capital. And that's not necessarily a bad thing. They're sort of, they're growing a bit faster. So it's all part of the equation. But if you have companies where they're going sort of, steadily down and down, that can be a red flag for sure. Losing market share. Now, that can be a bit difficult to determine, how businesses are measured. Defining their markets quite carefully is quite important, but again, declining market share is one. Declining revenue growth can be one, but clearly sometimes there are reasons, pandemic, to take a very obvious example, there might be a very obvious reason why revenue growth has slowed or gone negative. But that can be one as well. But it's very rare, actually, there's just one kind of thing. It's like, this is the reason why we're out. Usually it's a combination of things. Probably the other main one I'd mention is capital expenditure ramping up, sometimes quite dramatically. And this is obviously a big subject of debate in the AI world now. We've got Microsoft, which is holding in the Evenlode global income portfolio, spending a lot of money on capital expenditure. Is that a good thing? Is that a bad thing? I mean, I'm sure we don't have time to get into all that, but it's a critical question that we need to ask and be comfortable that that money that's being spent has a chance of generating a return.
On what time frame, though?
Yeah, another very, very good question. And anyone who's an AI booster will be telling you, well, it's okay because it's 30 years. We're long term. I mean, I think 30 years is probably stretching it even for us. But you do want to think about these things over a reasonable time frame. So we'd say minimum 5 years, like bare minimum. Probably thinking about what's the outlook on a 10-year plus. But that does create the challenge because there can be all sorts of things that happen in the meantime over that sort of time period.
We were talking about the quality style investment and that it's been underperforming lately because of the different factors you mentioned. How do you see it bouncing back when this whole AI craze is done?
Yeah, I mean, this is a question we get a lot of, as you might imagine. And of course, what we don't know is when the winds will shift. But I think there's probably a couple of scenarios that I can paint. The most obvious one, and the one that captures people's imagination, is the sort of dot-com style crash.
Everything just crumbles.
Everything crumbles, and suddenly businesses that are quite stable, that are reasonably valued, market thinks, actually maybe there's something in this, and but that comes as a result of something dramatic happening. I think if you look at what's happened over the last few years, what you've had is a re-rating of the overall market, driven by certain sectors, AI being a big part of it, and you had a sort of a gradual de-rating of quote-unquote quality companies. And I'm generalizing, but we see it in the portfolio. And I think there is a different scenario where there isn't this big crash. Maybe Nvidia's revenues just sort of they stabilize, and they're growing, but not quite as fast as they have been, and that's okay because they grow into their valuation, whatever. But there's just that headwind of multiple compression that has happened in the quality space that just stops. So if we look at the global income portfolio, even a global income portfolio, and we forecast, say, high single-digit free cash flow growth, plus a 5% free cash flow yield, I mean, all that needs to happen is the valuation multiples to stop contracting for that to be a double-digit return. Now, we might get a tailwind. I mean, I'm not predicting that at all, but it just goes to show we've got a reasonably growing portfolio, generates cash. Ultimately, the valuations are reasonable, and that growth will be felt, and it doesn't need something dramatic to happen in the other part of the market over a reasonable period of time for that to sort of shine through.
But if something dramatic happens, the people who kind of kept steady with their strategy will come out as the big winners.
Well, I think so, yeah. And I think that if you look at the sort of performance profile of our strategy over a longer period of time, certainly in those more difficult markets, it's when it's tended to outperform. Now, of course, that's not literally every day, clearly, but that's, we've seen that empirically. That's what we've experienced. And I would be, just given particularly where the valuations are relative to the market, I'd be extremely surprised if that didn't happen in the future, should that eventuality happen.
Passive investment, ETFs and the sort, they represent, I think, more than half of the global assets being managed today. How is that affecting active managers? And I mean, do you see that as a direct existential threat to active asset management, or do you see it creating different niche opportunities elsewhere?
Yeah, I think there's probably two elements to the answer to that question. There's one, the sort of competition for clients, so clients' assets, and the other is what's happening in the market and where's our opportunity set in terms of the investments we can make for our clients. So, clearly, passive investing has been growing since Vanguard launched. and there's been a pretty much one-way trip upwards in terms of market share. Now over half of assets under management globally, as you say, but actually started to dominate flows about 10 years ago. And when we think about the price action and the price impact of that, it's really the flows that matter, not the assets under management. So, this is something that's been going on for, it's been dominating flows for at least a decade. So it's been a long time coming. Now, clearly, passive strategies compete for our clients, and understandably, go and get something very cheap. It's not going to materially underperform whatever benchmark it is. You can see the appeal. I think this is where us as boutiques have a real role to play, actually, because we have one style of investing. I think that what that means is that we're probably reasonably well placed to set the price for our particular type of company. And I think there's a very important market role, actually, for truly active managers to do that in terms of market structure, but also as a proposition to clients. So, if a client comes to Evenlode Investment, I would like to think that they know exactly what they're going to get. And if they don't, then they need to tell me, because we need to communicate better. It's very clear what we do for our clients in a broader portfolio. And for some people, and myself included, that is basically 100% of their portfolio. Others blend it with different strategies, different styles, which is totally fine. The point is that they know what we do within that kind of broader portfolio. So I think that the boutique asset manager, and there are lots of great boutiques, have that ability to really do something that's well defined for clients. So there's that. I do think it's affecting market structure. I think it's affecting market prices.
Do you feel the pressure on pricing?
I think that if you look at what's happening to sort of Magnificent Seven, some of it is driven by growth and enthusiasm and all that stuff, but some of it is driven by passive flows, and that's not just sort of pure index tracking. If you've got any kind of algorithmic investment style that will buy an asset at any price, then it's the same problem, or the same effect. Problem. Well, maybe that's creating opportunity for us as active managers, because what we don't know, because we've never really been here before, is what happens when it goes the other way.
Automated panic selling?
Market history shows that things tend not to go up forever. To make a very basic point. And so, I think that there have been effects on companies. We've owned some of those companies and sold them as the valuations have got too stretched. But there are these other companies, not everything in the market has been going up, and certainly not everything that's quality in the market has been going up. And we're very selectively able to invest in those assets for our clients at what seem like very, very reasonable prices, more than reasonable, I'd say, in some cases. So, that sets the portfolio up. And as I was saying earlier, if we can then be patient and wait for whatever happens in the market to happen, maybe it's dramatic, maybe it's not. But I think that a strategy, if you stick with it, as you say, ultimately should, if as long as you're consistent and don't, blink when the time is wrong and bail out, which we're certainly not going to do, then ultimately good things should happen if the strategy is sensible.
Active managers around the world had to kind of review their management fees because of ETFs.
Yeah, I think that there certainly has been fee compression, and I think certainly in the UK, and I think you've seen this in Europe as well, continental Europe. We've gone from probably having pretty high fees, to be honest, if you go back 20 years, which was slightly before my time in the industry, but not too much prior to my time in the industry. So I think you have seen fees come down from probably too high a level to something that's reasonable. There is continued pressure, and I think that's okay. Keeps active managers honest in terms of their pricing. But I think I think that things have got to a level where they're more sustainable, more justifiable, dare I say it, compared to passives. Passives, if you want something dead cheap, it's a scale game. Fine, maybe I don't have anything against that, actually, particularly per se, as long as people understand what they're buying. And I think that has led to overall there being a better value proposition actually from active managers. So I think that's okay too.
I want to touch on Switzerland for a little bit. I know you go there regularly, you have clients there. How would you define the differences between the UK financial scene and the Swiss financial scene?
Yeah, I think they're quite similar. I think in many ways in terms of certainly their attitude to buying funds or using managers for segregated mandates or whatever. So I think in terms of being pretty sophisticated, thinking long term, generally speaking, asking difficult questions for sure, doing their homework, researching. And I'd say this is a question of degree. I'd say in Switzerland, it's probably harder to win the kind of the client, the trust. It's a long process. But my sense is, and I'd be interested in other views as well. But my observation is that once you build that relationship, then clients can be very loyal, and as long as they continue to understand what you're doing. So I think that might be, that's the case in the UK, but I think it's possibly even more so in Switzerland.
So can we say that it's less transactional and more relationship-based?
Yeah, but I think that the UK is also relationship-based, but I think we're talking about sort of maybe the next level.
Do you sell a fund in the same manner in London as you do with a Swiss wealth manager?
The short answer is yes. I think that the Swiss do sometimes ask slightly different questions and need a slightly different presentation, but it's fundamentally the same thing. I think for us, we've been established in the UK for a long time now, so we're generally a bit better known. So there's a bit more kind of intro. I don't think the Swiss need totally selling on the idea of investing in quality as a sort of good idea, but a little bit of explanation on how we go about it in terms of the detail of our process is more needed. But then, what if I'm now, nearly a couple of decades into my career, my formal professional investing career, and actually the people we are meeting, even if it's a firm that we've been dealing with for 15 years, the people are now changing. So there is a sort of re-education piece that we need to do as well to make sure that people understand what we're doing, how we've improved what we do. We do have a continuous improvement mindset, but also understand that we've not strayed from the path that we've set out for our clients as well.
You're based in the Cotswolds, not in the city.
No.
Tell us about that. Why? How come?
Well, I mentioned the genesis of the business earlier. So it happened that the Hugh's father's wealth management business, Wise Investment, which is still there, still going, is based in the Cotswolds. That's where Hugh grew up. So we started there.
And you never felt the need to kind of move into the city?
We never felt the need to. Yeah. We grew it there. Clearly, that's meant that our working patterns have had to, be suitable for that location, because not so many investee companies, not so many clients come past our door. So we've always had the flexible working thing, for example. But we've never felt the need to move. Initially, for the first few years, it was myself and Hugh. But then as we started to build the team, that was quite interesting, because we had to be sort of open-minded about where people live. Clearly, a lot of people do want to live in the Cotswolds, but not everyone does. So people do commute out, some people commute out from London. It's not very far away. When it is in the countryside, but people commute from the town where I live into the city every day. So it's perfectly possible. But yeah, we started there and didn't really feel the need to move, because we can move. We can go to where the clients are. We go and see companies where they are. We go to conferences. This standard stuff really. But I think that as we built the team, what we realized was there was something quite nice about being out of the city. So we come into the city, sitting in the city now. I was just talking to a company just before coming here. But when we're here, you're in the hubbub, and it's not to say you can't be a good fund manager being in the city, but I think it is helpful for us to then take all our learnings, go back to our office, and discuss under our own steam in our own terms, what we've found. So I think that there's a sort of away from the noise thing, which I think could be overstated, but I think actually for me, it's more the culture that engenders. So that idea of being independent, that idea of, maybe having to think in a contrarian way sometimes. And I think maybe right now is one of those times, and it's okay. And I think that the physical location helps sort of solidify and really bring that point home on a day-to-day basis as we're going about our business.
The quiet helps get more clarity, basically.
Yeah, I think it does. Yeah, and it's always that thought. I think I feel it, at least when I'm out seeing, if I'm in the States, say, seeing companies, or I'm in Europe seeing companies, I'm always thinking, right, I'm going to have to take this information back to this place where I know that my colleague is going to be very interested in what I found out, and it works both ways, of course. And I'm going to have to sort of come up with sensible ways forward with this idea, whether it's to develop it, invest in it, disregard it. I'm going to have to justify myself in our own self-defined world. So it's quite powerful, actually. It really gets me thinking. My colleagues get me thinking.
It's actually probably an important element of Evenlode's culture.
Absolutely. I think it's quite critical. I think the notion that we've sort of gone down this path this far and then taking a hypothetical world, then moved to the middle of the city of London. It wouldn't work for me, but I think that just in terms of that culture, I think that would have issues as well. So I think it really has helped develop that clarity of purpose, clarity of analysis as much as we can.
And honestly, I think it's quite an interesting differentiator in terms of the story you can tell.
Yeah, and it gives us some nice artwork for our presentations as well.
Ben Peters, thank you very much. That's it for today. Don't forget to click below to subscribe to the official Basis Points YouTube channel.